Next, we're going to tackle a topic that can feel a bit daunting at first, but is crucial for understanding your business's financial health. That is, how to read a balance sheet. Whether you're a small business owner or a manager, I'll break it down for you in a simple and straightforward way. So what is a balance sheet? A balance sheet is one of the three main financial statements alongside the profit and loss statement and the cash flow statement. It provides a snapshot of your business's financial position at a specific point in time. It shows what your business owns, what it owes, and what's left over for the owners, which is called owner's equity. The balance sheet follows a simple formula: equity equals assets less liabilities. Let's break this down further. First, let's talk about assets. Assets are everything your business owns that has value. These are divided into two categories: current assets and fixed assets. Current assets. These are assets that you can convert into cash within a year. Examples include cash, which is the money in your business bank account and your business till. Accounts receivable. This is the money owed to you by your customers for goods or services you've already delivered. Inventory or stock on hand. These are the products you have on hand that are ready to be sold. For example, if you own a small retail shop, your current assets might include $10,000 in cash, $5,000 in outstanding invoices from your customers, and $15,000 in stock. Fixed assets. These are long-term assets that your business uses over time. Examples include property. This might be a warehouse or office space. Equipment. This might be machinery or computers. Vehicles, like cars or trucks used for business operations. Let's say you run a construction business. Your fixed assets might include $50,000 worth of machinery and a $200,000 office building. Next, let's look at liabilities, which represent what your business owes to others. And like assets, liabilities are also divided into two categories: current liabilities and long-term liabilities. Current liabilities. These are obligations you need to pay within a year. Examples include accounts payable, which is money you owe to suppliers. Short-term loans. These are loans including the part of long-term loans that are due within the next 12 months. Tax payable. This is any outstanding tax obligations. For instance, a cafe might have $3,000 in unpaid supplier invoices and $1,000 in tax payable as current liabilities. Long-term liabilities. These are debts or obligations that extend beyond a year. Examples include mortgages. These are loans for property. Equipment loans. These are financing for machinery or vehicles. A manufacturing business might have a $100,000 mortgage on a factory and $25,000 in equipment loans as long-term liabilities. Finally, we have equity, which represents the owner's stake in the business. Equity is the amount left over after you subtract liabilities from assets. It's essentially the net worth of your business. Examples of equity include owner's capital, the money you, as the owner, have invested in the business. It might be, in the case of a company, share capital. Retained earnings, profits that you've reinvested into the business rather than taking as dividends or distributions. This will look different depending on your trading structure. Companies pay dividends to owners and trusts pay distributions to owners. For example, if your business owns $280,000 in assets and owes $129,000 in liabilities, your equity is $151,000. This means you, as the owner, have a $151,000 stake in the business. Now, what makes a healthy balance sheet? Here are a few key indicators. 1. Positive equity that increases each year. Assets should be greater than liabilities, meaning your business has value after all debts are paid. For example, if your assets total $280,000 and liabilities are $129,000, your equity is $151,000. That is a strong position. 2. Strong liquidity. Current assets should exceed current liabilities, and this ensures your business can cover short-term obligations. A healthy current ratio is typically around 2 to 1. For instance, if you have $30,000 in current assets versus $4,000 in current liabilities, your current ratio is 7.5 to 1 and is very healthy. 3. Low debt to equity ratio. This ratio compares total liabilities to equity. A lower ratio indicates financial stability. For example, a business with $129,000 in liabilities and $151,000 in equity has a debt-to-equity ratio of 0.85, which is considered strong. Anything under 1 shows that the owners are providing the majority of the funding for the business. And 4, diverse asset base. Having a mix of current and fixed assets ensures both liquidity and long-term stability. Finally, understanding a balance sheet helps you make informed decisions about your business's financial health. By regularly reviewing your assets, liabilities, and equity, you can identify areas for growth and areas that need improvement. If you're unsure about interpreting your balance sheet, reach out to us. We're here to help you navigate these numbers and ensure your business stays on the path to success. If you want to learn more about reading your financial statements, look at our online small business course. The link is in the description.